Welcome everyone to episode 6 of the Harry Sale Wealth Show. Today, my guest is Sonya Dolguina. She is on the tax team in Raymond James. Sonya, welcome to the show.
Thank you so much for having me, Harry. Appreciate it.
Thanks for coming on. And, just give everybody who's listening here just a quick background about yourself and what you do with clients at Raymond James.
Absolutely. So my name is Sonya Dolguina. I am a tax consulting manager at Raymond James. So my role is to work with financial advisors, financial planners, and essentially help clients with anything related to tax consulting. So related to individual tax, corporate tax, trust, estate planning. I'm a CPA in both Canada and in the US. My background was in public practice, where I was in a manager level, working in cross-border individual tax, working with a lot of expats, business travelers, and then came to Raymond James about a year and a half ago, and now just working on tax planning for more than just cross-border tax now, but a wider range of different taxpayers. I know today we'll be talking about small business owners and corporate business owners and how we help there.
As you mentioned, today we'll dive a little bit more into the incorporated side of people within Canada. So people who have the opportunity to run an incorporated business. And really, a lot of people will come up to me who have professions like a dentist, doctor, or a lawyer, and they might say, when would it be a good time for me to consider incorporating? And of course, what are the advantages? So maybe just take us through a little bit that you've seen of people who are transitioning from, sole proprietor or unincorporated to incorporated and why they did it.
First of all, from a legal perspective, individuals always want to consider the benefits of incorporation, mainly due to limited liability. So that's always one that could always be industry specific as well for, doctors, dentists, lawyers, for example. But just from a tax perspective, if someone is a sole proprietor, then any income that they generate is taxed based on the marginal tax rates. So it starts at around, and it depends on the province, starts around 20%. But once your income exceeds about $250,000, every dollar is generally taxed at 50 or 53%, depending on the province. But when should someone incorporate is when they generally don't need all of the income that they're bringing in for their lifestyle expenses. And if they could defer some tax on their income by keeping it within the corporation. And the big benefit is if you have active business income. So again, if you're earning business from medical practice or you're a consultant, active business income, the first $500,000 of active business income within a corporation is taxed at very low rates, about 10 to 12, 13%, depending on the province. So if you can pay tax at that lower rate, and if you don't actually need that money for, lifestyle expenses, housing, mortgage, and bills and whatnot, you could actually defer the income within the corporation, just pay that, roughly 12%, and you don't pay tax at the personal level on dividends or salary until you take it out. So you just have a lot more flexibility with being able to defer income tax on an individual level. And then on top of that, you have a significant benefit of being able to invest within the corporation and claim tax deductions. But a big one that I always highlight is the cost of incorporation. So there are legal and accounting fees in terms of setting up a corporation. And then on top of that, you have to file annual corporate tax returns every year and have, bookkeeping, accounting. So all of those things come with costs too. So just because someone looks at a low corporate tax rate doesn't mean that it's necessarily going to be advantageous to incorporate. I'd look at, are they actually going to have income to defer within the corporation? And what are the costs associated with incorporation? And does it make sense when you look at all those factors?
So let's say they do wind up getting incorporated. It makes complete sense for them. Income splitting with family members is certainly something that a lot of people ask me about. How can I incorporate my family? So maybe just give us a little bit of a background about how income splitting can work for an incorporated professional.
Sure. So first off, the general way that you would split income is either through dividends or through salary. So with dividends, you can only pay dividends to individuals who are shareholders. So if you want to pay dividends to a family member, they have to be a shareholder. So generally a good time to do that is when you're actually setting up the corporation and issuing shares, because that's a good opportunity to issue separate classes of shares to different family members. For example, a spouse can have a separate class of shares that is, for example, non-voting. I know for medical corporations, I believe in BC and Ontario, only the medical professional can have the voting shares. But if you have a corporation and you're only the shareholder, then you may have to do some reorganization down the line to be able to pay dividends to family members so that they actually hold shares. But a very important consideration is something called tax on split income, or TOSI rules. So if you are paying dividends to a shareholder, in certain situations, if they're not actually actively involved in the business and you're just splitting income so that you pay lower taxes, these TOSI rules can get in the way of that and actually determine that those dividends have to be taxed at the highest rate. So it doesn't really achieve the income splitting objective. So if you're issuing dividends, the individual generally has to be actively involved in the business. Ultimately, you can income split with family members in a corporation, but you can't just do it if they're not doing anything in the business necessarily.
I'm always curious to hear what, somebody like yourself might advise an incorporated professional. What's the best salary dividend mix for me?
So first off, salary is deductible to the corporation. So it reduces your corporate tax income, but it's also subject to CPP and EI. So a lot of individuals will say, oh, I don't want to pay into CPP. It's just an additional cost. But another way to look at it is, well, if you're paying into CPP, you're essentially paying into a guaranteed pension plan. I wouldn't necessarily discount paying into CPP just because it's an additional cost. You do ultimately get it back when you take it out. Also, salary does generate RRSP. It's considered earned income for generating RRSP room. So the way that I would look at it is, if you want to max out your RRSP, which is generally a good idea, then you want to pay yourself enough salary so that you can generate the maximum amount of RSP room. And then on top of that, if you pay dividends to yourself, if it's paid from the after-tax proceeds of active business income, they're generally considered non-eligible dividends, and they are taxed actually at a bit of a lower tax rate than salaries. Generally, the guidance is pay enough salary to max out your RSP room that you want to generate, and then don't just pay dividends unless you actually need the money, because then you're just triggering personal tax. You may be better off not paying dividends if you don't need the funds for an individual level, and retaining that in the corporation, potentially investing it, growing the value of your corporation that way, and then deferring the tax until you need to take the funds out.
Yeah. Yeah, we've heard a lot of people say, I don't want to pay CPP. I just give me dividends, a better tax treatment or what have you. But there are advantages to both. CPP in general is one of the last remaining defined benefit plans that most people can actually get. So don't discount that too much. But a number of people at this point would say, okay, great. I've set up my corporation. I've helped my family. I know how I'm going to pay myself, but how can I effectively get money out for personal use? So of course, we were just saying salary and dividends. What kind of strategies, or how can you efficiently withdraw money from a corporation for personal use?
The first thing I'd highlight is it's always important to keep a clear separation of expenses within the corporation and for personal use. Otherwise, when you're looking at withdrawing money from a corporation, again, it's generally a taxable salary or taxable dividend. So you want to look at, okay, if I'm taking money out of my corporation, what marginal tax bracket am I going to end up at? So if I'm having a very high income year on an individual level, maybe that's not a year where I want to withdraw money from my corporation. And then let's say timing is also a really important one. Let's say it's later on in the year, let's say around November, December, and I'm thinking about taking some money out of my corporation. Perhaps if you could wait until January of the following year to take money out of the corporation, you effectively have deferred the personal income tax liability associated with that for another year. So I guess the main things I would look at, what marginal tax rate are you going to be ending up at? Could you recognize income in a lower year, in a lower marginal tax rate year? And also, what is the timing? Can I defer dividends or salary or bonus to a subsequent year?
One of the last questions before we move on into what happens during the ownership process is in retirement. So a number of people have a corporation. All these people who aren't incorporated have TFSAs, RSPs, FHSAs. So what retirement savings options have you seen for business owners beside what they can put into their own RSP?
Yeah, so we could talk about three main ones. So one is IPP, individual pension plan. Generally, the ideal candidate is someone in their 40s and 50s who has paid themselves T4 income, so salary bonuses out of the corporation for the last few years. They can actually set up a pension plan within the corporation, and it's akin to a supercharged RRSP. You can make a lot larger tax deductible contributions and essentially set up a pension plan within the corporation, and that could be a really great income stream for retirement. So yeah, if you think you may fit that mold, you've been paying yourself a salary, maybe 150,000 at least over the last few years, you're in your 40s, it could be a good option. Another one is just investing within the corporation. So if you build up the value of the corporation, essentially that corporation can be an additional income stream during retirement. So during retirement, you may not be earning a lot of other income. You may be in a lower tax bracket, and you could then start pulling dividends out from your corporation at retirement. And it could build an additional income stream. And then another good option is corporate owned life insurance. You can use your after-tax earnings in the corporation to fund premiums. And ultimately, it could be a good way to manage matters from an estate planning perspective, a liquidity perspective. You know, if you're leaving your shares to the next generation and you're expecting maybe a significant tax bill at death, having corporate owned life insurance could solve a lot of problems in that regard.
Yep. Now, those are three excellent strategies. When you have retained earnings, sometimes if people have a very long career or they've done very well, they're not taking too much salary or dividend and it's retained in the company, they might have significant retained earnings. And in retirement or when they want to make a withdrawal, it could be, a significant tax planning opportunity. But I'm really curious about people who have a lot of accumulated retained earnings. What kind of tax planning strategies can you implement to or for them just to make sure that they're taken care of from a tax perspective?
Well, the big one is investing within the corporation. So a lot of business owners may not even know that they can invest within the corporation. And that ultimately is a way to build the value of the corporation, build the wealth, build the amount that you can, take out at retirement or during your, before retirement. So something to note is when you do invest within a corporation, there are generally higher corporate tax rates. So maybe around 50% for tax rates on, interest, and the 50% taxable portion of capital gains, foreign dividends. But ultimately, even though the tax rates are higher, because you may be starting with a larger amount of capital to invest, because you only paid around 10 to 13% tax on that income in the corporation, you may still be better off by still investing in the corporation rather than withdrawing it and investing in a taxable non-registered account. Another consideration is CDA, capital dividend account. So CDA is essentially a notional account within the corporation, and it encompasses a few different things, but the main one is the non-taxable portion of capital gains. So if you're investing within a corporation and then you realize gains, the non-taxable portion goes into the CDA account. And once you build up a CDA pool, that can actually be withdrawn as tax-free dividends to the shareholder. You have to file an election, but that is another advantage to investing within the corporation.
Yeah. And another advantage of working with a tax team.
Yeah.
When some people get a ton of passive income in their corporations, they will eventually have an issue with the small business deduction. Can you give us a little bit of color on that?
Sure. The way that the small business deduction works is the first $500,000 of active business income within the corporation is taxed at those very low rates that I mentioned. But once you generate passive income within the corporation or an associated corporation, which means you can't skirt around these rules just by opening up a separate company, it looks at all your associated corporations. Once in aggregate, though, that passive income exceeds $50,000, then every dollar in excess of that grinds down $5 of that $500,000 limit, which means that if I earn $100,000 of passive income in my corporation, then that could mean that my small business deduction is ground down to the first $250,000 of active business income. So whether or not that actually impacts individuals, it depends. It depends how much active business income you're actually earning in the corporate. Again, any salary that you take reduces your business income. And then another consideration is that, so once your passive income reaches $150,000, then your small business deduction is eliminated. So what could you do to manage this? Another consideration is the type of investments within the corporation that could manage this passive income issue. And that is the fact that capital gains, only 50% of capital gains are taxable versus 100% of income such as dividends and interest. So that means for every dollar of capital gains that are generated, only 50 cents of that goes towards that passive income limit. So that's another way to manage it. But overall, it's good to talk to an accountant. It's not necessarily the case that in all provinces you're better off, or you're worse off rather, from an after-tax perspective because of exceeding the passive income rules, just because you may be able to pay out more tax-effective dividends to the shareholder once you take money out of the corporation. Definitely good to talk to an accountant, talk to your financial advisor. If you're kind of approaching that $50,000 rule, maybe look at rebalancing your portfolio to manage those matters.
Yeah, no, I appreciate that. And some of the people that I've talked to also say, I have a lot of, not trapped, but I want to make sure I'm taking some funds out in a tax efficient manner. What we would normally recommend as financial advisors looking towards charitable giving. So I know that's certainly something that you can do within a corporation and personally, but I'm just curious about what are the tax implications of donations that are made through corporations or even personally?
Sure. So when an individual donates, they get a donation tax credit. So the first $200 of donations, you get the credit at generally the lowest marginal tax rate. Donations in excess of that amount are actually, you get the tax credit at a higher rate. And ultimately, you may get back around 50% of what you put in as a result of the tax credit, and ultimately a higher tax refund potentially. So that is donating through as an individual. And another very significant matter that applies to both individuals and corporations is donating appreciated securities. So if you have shares in a non-registered account as an individual or as in a corporate investment account, and they have appreciated in value, you can donate those directly to the charity, and there are no capital gains taxes. So effectively, if you're looking at someone who wants to donate, say, $100,000, they're much better off donating shares worth $100,000 that have some capital gains rather than selling those shares, paying tax on the capital gains, and then donating the cash. So that's a really good method. And then when you have a corporation, rather than a tax credit, you get a tax deduction for the value of the shares that you donate or the cash that you donate. And ultimately, you can get a benefit by donating shares through from the corporation because, again, not only do you get a tax deduction, you have 0% inclusion rate on any gains. And then also, let's say someone is approaching that passive income limit where their small business deduction might be ground down. You can actually allocate the tax deduction from the value of your donation to that passive income. So it reduces the amount of passive income that it is ultimately considered for whether or not your small business deduction is going to be impacted.
Some advanced strategies there. That's really valuable. Speaking of that, we'll get into a little bit more towards the sale of business and then retirement. So, just as a thread, we've opened up the incorporated business. You have funded it. You have tons of money in it. You're trying to get, yourself a salary and pay yourself in a tax efficient manner. When it comes to exiting, there is a lifetime capital gains exemption. So maybe just walk us through what that amount is currently. And I guess, how does that work when you're trying to sell shares of a small business?
Sure. So essentially the lifetime capital gains exemption is essentially a cumulative exemption that each individual gets. And it is, for right now, it's $1.25 million, which means when you sell qualified small business corporation shares, you could exempt $1.25 million of the capital gain from taxation. So obviously a very, very powerful strategy. But there are a lot of considerations and not all people qualify. So first off, it applies to the sale of shares. So if you're selling assets in your business and the buyer wants to buy the assets but not the shares, then that doesn't qualify for the lifetime capital gains exemption. Also, it has to be an individual who claims the lifetime capital gains exemption. So if you have a corporate structure where you have a holding company that has shares of the operating company and the holding company sells the shares of the operating company, that doesn't qualify for the lifetime capital gains exemption because you as an individual has to hold shares. If you have that kind of structure, that doesn't mean that you can never claim the lifetime capital gains exemption, but you have to talk with an accountant on ways to come up with the strategy. And ultimately, the important things we talk about is, okay, it's not all shares that qualify for the lifetime capital gains exemption. It has to be qualified small business corporation shares. So the main criteria is effectively you had to have you or your spouse essentially or someone related to you had to have held the corporations throughout the 24 months immediately preceding the disposition. And the key one is that throughout the 24 months preceding the disposition, more than 50% of the fair market value of the assets must have been principally used in an active business, primarily in Canada. So really active Canadian businesses. And also this is the big one, at the time that you sell the shares, 90% or more, which is all or substantially all of the fair market value of the assets had to have been used in an active business. I always advise at least 2 years ahead of a planned sale to make sure you reach out to a qualified corporate tax accountant and make sure you're in the position to qualify.
We say almost the same thing for retirement, maybe even 5 years ahead just to be safe, but just make sure that you have those conversations. The earlier you do have the conversation, the more somebody like Sonya or myself can help you out. So I'm just curious, somebody's coming up to you and said, I have a business, I'd like to pass it to my children, and I've heard about an estate freeze. Maybe just walk us through the process of that and some of the advantages.
Sure. So essentially what an estate freeze does is, as the name suggests, you're kind of freezing the value of your corporation, or at least your shares of the corporation, and allowing the growth of the company after the freeze to go to the next generation. So there's a number of ways that this is achieved, but the common strategy is a two-step process. So first you could do a tax-free or tax-deferred exchange of your common shares for fixed value preferred shares. And essentially those preferred shares will have a fixed redemption value based on the value of your company at that time. Then you issue in exchange for nominal value common shares. And those common shares are generally owned by a newly set up family trust. And then the family trust has the beneficiaries who may be your children, your spouse, and whatnot. And any growth of the company from that point onwards will go to the common shares rather than the preferred shares. You'd have to be careful with this arrangement. If properly structured, essentially, you may be able to multiply the lifetime capital gains exemption because upon the future sale of the business or a future taxable event that will trigger a disposition of the shares, essentially each beneficiary may be able to claim the lifetime capital gains exemption on the taxable disposition of the shares. So it's 1.25 million of tax-free gains for each beneficiary. So there are lots and lots of considerations, but an estate freeze can definitely be a significant and useful planning tool for business owners.
So what we'll do now, we'll move into 3 questions essentially that I've received from clients. I've paraphrased them to make them easy to digest and understandable, but really the first one I had was a medical professional, and they said to me essentially, my medical corporation has accumulated about $800,000 in cash beyond what I need for day-to-day operations or even short-term planning. I'm 45 years old. I'm wondering if I should invest this money within the corporation, withdraw it personally to invest, or use it to purchase a commercial property for my practice. What would be the tax implications of each?
So the first one is if you withdraw it to invest, taking out $800,000 likely as a taxable dividend. Most of that is going to be taxed at over 50% depending on the province. So probably not a great idea unless you have a lot of room in your registered accounts. Then maybe it makes sense to take some of that out, at least, maxing out the TFSA. So that maybe not ideal to take everything out, or purchasing a commercial property. So again, if that could make sense is purchase, because again, a commercial property is just another banner of an investment within the corporation. So If you are earning passive rental income, for example, from that corporation, then, or from that commercial property, then that will be considered passive income. It's going to be taxed at kind of higher rates within the corporation, around 50%, but part of that is a refundable tax when you pay out dividends. And then a lot of that is kind of an investment question as well. Like, what is your rate of return on this commercial property? Could you get a similar or even better rate of return on something that maybe isn't as involved, so to speak? So that is maybe an investment question rather than a tax question. But I see, medical professional, 45 years old, something thinking of as an IPP, an investment pension plan, they may be ideal candidates for that. And then again, like I mentioned, that's like a supercharged RRSP within the corporation. And then that could be a good option for them as well.
Perfect. Yeah, thank you for that. We'll just move on to physiotherapists. So they asked me essentially that they have an incorporated clinic. They also earn income from consulting, teaching at a university, and selling some products online. So their question to me was, what's the most tax efficient way to structure these various income streams? And should everything flow through one corporation or should I have multiple entities?
Sure. So the way I may look at that question is, with multiple entities, is there perhaps a legal reason why you may want to separate and have separate corporate structures just from a limited liability perspective? If you are in the medical services and then you're also selling products online, then maybe that does make sense to have separate corporations. Ultimately, you're not necessarily taxed in a better manner just because you're earning that income through multiple corporations. Generally, if it's active business income, then it's going to be taxed at a flat rate in the corporation. And then also that $500,000 active business limit, it's actually shared between associated corporations. So it's not like every corporation gets the first $500,000 taxed at the advantageous rate. It has to be shared. But another way I would look at that question is, each corporation that you have has to file separate corporate tax returns. So sometimes people do set up, many corporations for all their various endeavors, and then they ask, why am I paying my accountant so much money? Well, because they have to file separate corporate tax returns, and a lot of work gets involved in that, and separate payroll filing, GST filing, for example. So that's another consideration, just administrative costs. Having just one corporation will definitely make that potentially less burdensome and easier.
And we'll just move on to the last question. The last question I had is, I'm a 62-year-old business owner. They've done really well. They have about 1.5 million in the corporation retained and about $600,000 in their RSPs. So they've obviously done a very good job of saving. They want to retire next year. What's the most tax efficient way to draw income during retirement? And the follow-up was also, should I wind up my corporation immediately or should I keep it as an income splitting vehicle?
The first thing I look at is, you have a 62-year-old. So they have an RRSP that doesn't technically need to be touched and withdrawn on for at least another 10 years. Because at the end of the year that you turn 71, you have to turn your RRSP into a RIF. And then at 72, you have to start making withdrawals from that corporation. So what that means is this individual has, 10 years plus that they can still grow their RRSP in a completely tax deferred manner. So generally speaking, you don't necessarily want to withdraw from the RRSP if you can keep that growing tax deferred. So I did a quick calculation. I think about a 5% rate of return over 10 years, that 600,000 could be over $1 million. So just because of the fact that you're not paying any taxes within the RRSP on the growth. So $1.5 million in the corporation, definitely a good way is to draw income from that corporation. If they're also 62 years old, they may not be taking out CPP and OAS yet. So they have the opportunity to defer that until, up to age 70 and get even higher payments. And then that could mean that they could take more money out of the corporation and kind of still have it taxed at lower rates. So that's generally how I would look at it. Is, again, probably doesn't make sense to wind up the corporation immediately, because that could effectively be a $1.5 million dividend taxed at mainly at over 50%, which we don't really want. You could strategically draw money on an annual basis and keep it as an income splitting vehicle. If you have a spouse as a shareholder, again, that could be a very advantageous way to do that.
I appreciate it, Sonya. Thank you very much. We've kind of reached the end here, but I always at the end like to just say, if there's any other notes or questions for anybody who's made it all the way to the end of this video, a lot of people do have questions. Maybe just a final note about some common things that you're seeing these days, and maybe we can just leave it there.
Yeah. So, we definitely see a very common note of RSP versus dividends. How much should I draw from my corporation? Also, income splitting. So those are like the very, very common ones that I get a lot and that we have definitely covered. So I would say that the number one thing is, if you think you have a really good idea from a tax perspective, but it hasn't been run by a CPA, then make sure you get good advice, because a lot of people maybe make decisions based on maybe misunderstandings of the way that taxes work, and it could end up being quite costly in the end. So always good, a CPA might cost you a bit of money, but a bad tax mistake could potentially cost you more.
A bit. Thank you very much for your time, Sonya.
Thanks, Harry.